We often hear that the market is efficient, that prices reflect all available information, making it nearly impossible to consistently outperform. It's a powerful idea, one that shapes much of the advice we receive, and for many, it breeds a quiet frustration. If the market is so efficient, why does it feel so chaotic? Why do we struggle to translate complex theories into tangible, sustainable wealth? Perhaps the very notion of perfect efficiency is the biggest myth of all. This isn't about chasing speculative gains or believing in a secret formula. It's about peeling back the layers, questioning the consensus with a critical, data-driven lens. It's about understanding that while markets are incredibly sophisticated, they are not always rational. Benjamin Graham, the father of value investing, understood this deeply. He told us the investor's chief problem is never the market itself, but always himself. And he added, the stock market is a voting machine in the short run, but a weighing machine in the long run. This distinction is crucial. In the short run, markets can be swayed by sentiment, by emotion, by the herd, a voting machine. But in the long run, value, substance, and genuine worth are what ultimately matter, a weighing machine. The myth of perfect market efficiency often ignores this fundamental duality, leading us to believe that prices are always, unequivocally, the correct reflection of value. Today, we're going to challenge that assumption. We'll explore 5 pervasive myths about market efficiency that may be holding you back, and in doing so, uncover a more profound, more attainable path to true financial mastery. Is your understanding of market efficiency blinding you to opportunity, or worse, to risk? Let's begin to find out. Let's confront the first myth, that all information is instantly priced into the market. The efficient market hypothesis, in its strongest forms, suggests this is the case, that the moment news breaks, the price of a stock or asset adjusts perfectly and immediately. But is this truly how reality unfolds? Think about a grand library filled with countless books. Each new book represents a piece of information entering the marketplace. The myth claims that the moment a book arrives, its true worth is instantly understood and reflected in its shelf placement and perceived value. However, we know human beings are not always instant processors. We read slowly. Some books, especially those dense with complex narratives or subtle insights, take time to digest. Others might be placed on a lower shelf, perhaps overlooked for a while, not because they lack value, but because their significance hasn't yet been fully appreciated by the majority. This delay, this reading lag, is not a flaw in the system. It's an inherent characteristic of how information truly integrates into complex markets. To believe that acting on new information is always futile is to accept a market that is perfectly and instantaneously rational. But history and data tell a different story. Sophisticated investors, those who build sustainable wealth, understand that information rarely travels in a straight, immediate line to price. They develop frameworks to identify those slowly digested pieces of information. This might involve deeply understanding complex regulatory shifts, subtle changes in competitive landscapes, or nuanced industry trends that the broader market hasn't yet fully grasped. It requires patient observation, a commitment to qualitative analysis, and a deep dive beyond the headlines. The market, you see, is not a flawless oracle. It's a dynamic, often slow-moving ecosystem where information's journey to its true price is frequently a winding, patient path, not an instantaneous one. And within that path lie opportunities for those willing to look. Now, let's tackle myth number 2, the idea that markets follow a random walk. This concept suggests that future price movements are entirely unpredictable, completely independent of past price changes. Like flipping a coin, each event is a singular occurrence, with no bearing on the next. If this were entirely true, then any attempt to analyze historical data for patterns or predict future trends would be a futile endeavor. But consider this: what if the coin isn't perfectly fair? What if there's a slight, almost imperceptible bias, a subtle weight to the coin that favors heads or tails over time? Or what if the person flipping the coin has a predictable, albeit unconscious, tendency in their technique? This is where the random walk theory, as applied to markets, begins to fray. Markets, while exhibiting chaotic elements, are not purely random. They are influenced by human behavior, by economic cycles, and by structural factors that can create persistent, albeit subtle, patterns. We see evidence of this in market anomalies, in the consistent outperformance of certain investment styles like value or momentum, and in the predictable swings of market sentiment. These aren't random occurrences. They are statistical deviations that contradict the notion of pure chance. For the discerning investor, this is not a cause for despair, but an invitation to a more rigorous approach. By employing quantitative analysis, we can identify these statistically significant deviations from pure randomness. We can then construct portfolios not by assuming away these patterns, but by strategically and patiently exploiting them. Understanding these non-random elements offers a distinct advantage. It's not about predicting the unpredictable with certainty, but about recognizing and acting upon the subtle rhythms within the apparent chaos. Let's dismantle myth number 3, the assertion that there's no room for smart money. That active management management is inherently futile, and that consistently generating alpha, that excess return above a benchmark, is an illusion. The efficient market hypothesis often leads us to believe that any outperformance is simply luck, a temporary deviation from the norm, or a result of taking on undue risk. It suggests that trying to find an edge is a fool's errand. Imagine a bustling city where every house's exact value is known to everyone instantly. In such a market, there would be no bargains to uncover, no properties mispriced. EMH suggests that stock markets operate with this level of perfect, ubiquitous knowledge. But again, is this the full picture? What if certain individuals possess superior maps, access to information before it's widely disseminated, or a profound, almost intuitive understanding of true structural quality that others miss? These are the elements that allow for the discovery of value. The reality is, history offers compelling examples of funds, investors, and distinct strategies that have demonstrably outperformed passive benchmarks over extended periods. These aren't isolated lucky breaks, they are often the result of deep, painstaking fundamental analysis, a courageous contrarian mindset, or access to unique data and insights. The key isn't blindly searching for alpha, but learning to identify its genuine sources. This involves scrutinizing the underlying analytical rigor, the robust risk management practices, and the sustainable competitive advantages that truly differentiate successful strategies. Alpha, far from being a myth, is often the tangible reward for superior intellect, unwavering discipline, and the courage to forge a path distinct from the consensus. It is the product of diligent inquiry, not mere chance. Let's move to myth number 4. The idea that market bubbles and crashes are merely irrational anomalies, random fits of madness in an otherwise efficient system. The efficient market hypothesis struggles to fully account for these dramatic swings, often dismissing them as noise or unpredictable events. But what if these cycles are not anomalies at all, but rather inherent features of how markets function? Think of it this way. EMH might see a speculative bubble as a sudden, inexplicable fever in an otherwise perfectly healthy body, but perhaps it's more accurate to say that certain underlying body conditions, like widespread herd mentality, the siren song of readily available cheap credit, or the intoxicating allure of a hot new technology, make such fevers not just possible, but predictably recurrent. These are not random glitches, they are conditions that foster an environment where irrational exuberance can take hold. From a behavioral finance perspective, we see how powerful psychological biases interact with market structures. Herding behavior, the fear of missing out, irrational exuberance during booms, and the sheer panic during downturns, these are not random acts. They are deeply ingrained human responses that, when amplified by market dynamics and information flows, create predictable cycles of boom and bust. Recognizing the early warning signs of speculative manias, understanding the mechanics of market contagions, isn't about perfectly timing market tops and bottoms, a near impossibility. Instead, it's about developing the wisdom to avoid the most extreme risks, to protect your capital when the herd stampedes, and to potentially recognize opportunities when dislocations occur. Bubbles and crash, then, are not bugs in the financial system. They are features that emerge from the complex interplay of human psychology and the very structure of our markets. We arrive at myth number 5, a cornerstone of much conventional financial advice, that the average investor cannot outperform, and that broad diversification into index funds is the only sensible path. The efficient market hypothesis, in its relentless pursuit of simplicity, suggests that trying to pick individual winners is a fool's game, destined to yield results no better than the market average, especially after accounting for costs. Consider this analogy. If every restaurant in the city served food that was perfectly, uniformly average, and all charged the same price, then why would anyone bother seeking out a specific, exceptional chef? VMH implies that stocks are like this average food, all equally good, all equally priced. But we know this isn't true. We know exceptional chefs exist, creating dishes of remarkable quality that are worth finding, worth the effort of seeking out. Challenging the notion that average is the only attainable outcome requires embracing the principles of value investing. It means understanding that true wealth creation often stems from informed concentration, not just broad participation. This path is paved with deep research, a meticulous search for undervalued assets, and the crucial application of a margin of safety. It's about developing the skills and the unwavering discipline to identify those high-conviction opportunities, those exceptional chefs in the market. Managing the inherent risks of concentration isn't about avoiding risk altogether, but about mitigating it through rigorous due diligence and an unshakable long-term perspective. The market, in its deepest sense, rewards understanding and insight, not merely passive participation. By questioning the myth of inescapable average, we begin to unlock the potential for truly informed, strategic wealth creation. We've journeyed through 5 pervasive myths surrounding market efficiency. We've seen that information doesn't always price in instantly, that markets aren't purely random walks, that genuine alpha can indeed indeed be found, that bubbles and crashes are not anomalies but features, and that the average investor can, with diligence, achieve more than mere participation. These aren't just academic points, they are fundamental shifts in perspective. Understanding these market imperfections isn't about finding a shortcut to riches or seeking to game the system. It's about aligning our investment strategies with the reality of how markets actually function, not how they are sometimes idealized to function. It's about embracing a more sophisticated, data-driven approach that acknowledges both the analytical and the behavioral dimensions of finance. This journey requires a commitment to critical thinking, a deep dive into data, and a keen awareness of our own psychological biases. It's about moving beyond the headlines and the superficial narratives to uncover the genuine underlying mechanisms at play. Warren Buffett, a master of navigating these complexities, reminds us it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This wisdom underscores the value of discerning true, enduring quality, something that market imperfections, when understood, allow us to do. As you continue your pursuit of financial mastery, I urge you to carry this spirit of inquiry forward. Continue to question conventional wisdom. Seek out those deeper, more nuanced understandings of market dynamics. Don't just accept what you're told. Analyze it, test it, and build your strategy on a foundation of truth, not myth. How will you begin to apply this more critical, reality-aligned perspective to your own investment decisions starting today?